We are now hanging right here on the 100, and that is, wow, that is very interesting. So we're either going to give it up to the downside, very bullish for precious metals, both of them, particularly silver, or there could be a possible downside event that somehow is bad for precious metals and gold goes down less. So if we have a shock to the system, typically the selling in gold will be less. Why? The central bankers will be there buying it up. They don't buy silver. So we'll have to see. But technically right now, we actually see the possibility that you could have a downside dip, which would be very bullish silver, which could mean the silver season starts.
While gold dominates headlines, silver is quietly building momentum. Analysts point to silver's strong industrial demand, growing green energy applications, and its tendency to outperform gold during late-stage rallies. The global silver market size is projected to grow from $95.2 billion in 2025 to $202.07 billion by 2033, exhibiting a compound annual growth rate of 9.86% during the forecast period. Market sniper FrancisHunt predicts a broad market financial liquidation event. Gold is expected to hold up better than silver due to its central bank demand, potentially causing the ratio to spike upward toward 110. However, if precious metals rise, especially silver, the GSR could break down toward 93, indicating that silver outperforms gold. It's worth recalling that central banks are buying gold on an ever-increasing scale, and last year, their official purchases reached 1,045 tons, a record both historic and symbolic, as it exceeded 1,000 tons. These purchases, dominated by emerging countries, clearly testify to gold's growing importance in the international financial system. While reflecting on his portfolio, Hunt mentions that he's currently weighted 75% gold and 25% silver. But if a clear trend emerges to the downside, he plans to go 100% silver. He cautions silver bulls to be patient, noting that silver's season may be near, but it has not been confirmed just yet. For investors, silver has delivered an approximate price return of 20.3% in the past 2 years, despite being more volatile than gold. However, whether silver or gold, market watchers believe investors will continue to flock to safe haven assets as long as instability prevails in the global economy. FrancisHunt analyzes the gold-silver ratio, highlighting its tight consolidation around the critical 100 level. He warns this low volatility squeeze often signals an imminent breakout. A major market move is likely approaching. Before we dive into FrancisHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets.
And I do the same comparison. You can see quite clearly that you're underperforming chronically. So not all metal stocks are equal, which is not to say that'll always be the case for First Majestic, but you can see the difference Wheaton and Orla have, and I think AEM, it was in that same category, the three that we liked. Very, very good performer, most of the time beating the metal. So it's very important which ones you select. It'll highlight management, earnings, outcomes, very, very key. Not all gold or silver miners, because First Majestic is more silver miner. It's a bit harder on them to compare it to the silver price. They do, of course, pull out gold, not just silver. So that was also maybe a bit harsh on them. And again, it points out it's the manner, the firing order. Gold first, then silver. We may, in fact, be coming back to First Majestic and as silver starts to outperform. Let's cover the gold-silver ratio, because we've said be careful. There's that possibility that it could get worse before it gets better. Now, we're going to take stock on that, because I've got an update for you on the gold-silver ratio. So we've covered Japanese debt, why the carry trade could unwind, why that will be doubly bad on the dollar, in our opinion, particularly the currency, and could be a very, very interesting time indeed for that. Let's just put on. So here's how gold-silver ratio has been playing. And this is fascinating. You notice how we in HVF method always talk about key levels of significance. What's the key level of significance in gold-silver ratio? 100. Thank you. At the back there. There it is, right there. And you have been dovetailing around the 100, squeezing ever low. This is a warning for me. This is a warning indicator. Incredibly low volatility on the gold-silver ratio tells me we are up. We are awaiting an event of some sudden shock. There's going to be an expansion in the volatility. Now, which direction for the gold-silver ratio? a little bit more ambiguous for me, but I would say it's possible it could be to the downside, which would be good for silver and probably good for gold, but not as good. So it could be that we're close to a turn here. It could be. This is quite a harsh slap in the face there. These are long, weak grinds. However, if we were to get a disorderly financial event that causes a sell-off and a liquidation for everybody, which is not beyond the realms of possibility, gold will not sell off as much as silver. And that's when this can move the other way. That's a fundamental statement. The technical statement, that, as I'm looking at it right now, it's getting very low vol, but actually it's squeezing across the tops and is kind of flat along the bottom. So that's very descending triangle. So we are now hanging right here on the 100. And that is, wow, that is very interesting. So we're either going to give it up to the downside, very bullish for precious metals, both of them, particularly silver, or there could be a possible downside event that somehow is bad for precious metals and gold goes down less. So if we have a shock to the system, typically the selling in gold will be less. Why? The central bankers will be there buying it up. They don't buy silver. It takes way too much space, not enough value. So the big money buys gold. So we'll have to see. But technically right now, we actually see the possibility that you could have a downside dip, which would be very bullish silver, which could mean the silver season starts. Remember, we didn't say it has to go higher. We warned people when they were here that you could go higher. You came down, you had that, you went higher already once, and then you went similar height again. So we just warn people, don't give up on stage one too soon. Let's have a look. Let's draw that gold-silver ratio, by the way. I am still continuing to add 75-25. The minute it's clearly a top and we go down, I go 100% silver. So I don't go half-mast, I go 100% on the silver. That hasn't happened yet, but there is a real vibe about this structure, the gold-silver ratio. It is a something's coming vibe. There we go, we're finding it, our draw tool. So that would be if it was an upside move. We have got a volatility squeeze. That would point to 110. But I think there's just as much possibility, maybe even a bit more, that this could be, and that would look like that pointing to 93. So this would then be your trend change event, a slap in the face. We are then hanging tough on this 100 level. I know a lot of silver people would be begging for this to be the scenario. And I just say, be warned, this amount of narrow volatility for such a sustained period, literally hanging on the 100, is telling me something. There's something brewing and a major move is coming. A major volatility-based expansion move is coming. Not far off. Down or up, one way or another, we're going to leave this range with momentum. Boop! That's what's going to happen, or down to the same degree. So we've modeled it both ways. We'll see how it comes. But it literally is turning into spinning tops on the 100. So the minute it falls below 100, people are buying up gold more than silver. The minute we get a little bit high, we get 104s, 103s. Up top here, let's draw a couple of levels. The minute we're around about here, people start buying silver. Buy silver, buy silver, buy silver, buy silver. So the ratio at 100 is being maintained. It almost looks managed. Managed? Conspiracy? Who knows? Who knows? Who knows? Who knows? I don't know. I don't know anything. I'm just saying. I'm just the observer. So you're sitting here between 98.5 and about 102. And that seems a very well managed range. By the way, you can put volume by price and you can see that it's to the lower side. So it's leaning on the floor is what we typically say. So since we made the 98.5 range, we'd go here, pull it across. That's where you are. Maybe I did it a bit soon. What about it? There you kind of did it. Okay. That's very, very tight. The volume by price all through that 100. I've done two. I've done it there. that's in the upside structure. Very, very heavy on the 100 volume by price. It looks almost managed. It looks almost managed. And a big move is coming. If it's a downside shock move that sees everyone liquidate, I see this going up. If it is bad news but bullish for gold, I see silver going up even more. In other words, I see this going down. So it's either going to be good for PMs, which is going to be doubly good for silver, or it's going to be bad generally for the world, and gold is holding up better than silver.
In his analysis, FrancisHunt explains that the decline of Treasury bond ETFs began with a sharp, profitable short trade but has since turned into a slower bleed-out. Regarding central banks, Hunt notes that Japan's balance sheet exceeds 120% of its GDP, warning against blindly trusting Western narratives. Wednesday's 40-year debt sale is coming at a time when long-term borrowing costs have also surged in other major economies, including the U.S. Japan's super-long bonds became increasingly unstable after last week's 20-year debt auction drew the weakest demand in more than a decade. That sent jitters through global markets. Concurrently, Hunt notes the focus has shifted from falling U.S. debt to dollar weakness, as the DXY drops from 110 to below 100. Since fiat comparisons are flawed, he sees gold as the real benchmark. This marks a substitution trade, selling debt to buy gold. Gold and national debt have been in a long-term race, and gold is emerging as the winner. Since 2000, U.S. debt has surged by 530%, while gold prices have skyrocketed by 880%. Rising U.S. government debt levels will continue to push more investors toward gold as they seek value and safety in the marketplace, according to one market strategist. Let's get back to the interview.
Maybe a little bit higher. Let's go have a look. That was the TLT, by the way. That's what we shorted. We can go have a look at the TLT to see how it's doing. Let's go and jump on. It's essentially a long-term bond ETF. So that's the one we were able to get puts on. You can see how it's grinding out further lows. In fact, it did one little bounce, couldn't take out the target, the original head and shoulder target, down, broke out of the falling wedge, down, rally, down. It's actually made a new low. This is a bleed out though. It's a slow, it's not super profitable. That is where you made your money, jumping in on the right shoulder and the original fall here. Those two moves are the money makers. The shouldering period was quite lengthy and went higher than the left shoulder, as you can see, which we tend not to like, but it doesn't put us off entirely. There was a very clear ceiling there when it attempted to rally a number of times. Everybody was calling the pivot. They were buying the story. Remember, pivot narratives? We said no, rates higher for longer, higher highs, higher lows. That means debt valuations down. How are we doing since those calls that we made? Down, down, down. Even if you draw it right the way from there to there, it's down, it's down. Debt is losing value. But what's happened since is that the currency has taken over. So this is building up to some of the points I like to make. First, it's the debt, but they are one of the same. That wears the loss. Once everybody gets to see that it is the currency that's getting beaten up, you then get the downside, the debt that's getting beaten up, you get the downside on the currency. You can see more recently here how it's the dollar. The debt actually got a minor bid, TLT, the long-term debt, but the dollar took the beating during that phase. And you went from 110 on the Dixie, right the way down to sub 100. That is quite a substantial loss. So that's where we kind of are now. But the Dixie is not the perfect tool because it compares against flawed fiats such as euro, which is 52% of that, the Japanese yen, the British pound, the Swiss franc, the Swedish krona, and one or two others to lesser degrees. So you should actually be looking at, you guessed it, our friend gold. So as the dollar devalues and the debt devalues, what did gold do over the same time frame? This is what gold has been doing while the debt valuations have dropped. And it's quite clean and clear to see. There was your peak debt moment. There was sideways. Here's when you started to short debt. Gold stood still. Rally, rally, rally. Debt was devaluing. And then gold started to take off, and off. More and more people. So we were early, remember. We said here on the inverted ascending HVF on the TLT, this is a short debt. You want to be short debt, and that the long term, the reserve asset that will be keeping you in good stead will be gold. But gold had already just made a high on the CV19 print. So it shook its head for the better part of 3 years and is now playing major catch-up. Now playing major catch-up against the debt markets that topped in 2020. Gold topped shortly thereafter, went sideways for a while, and is now running. With every tick you take downside on debt, you're going to be more likely to be matched with upside on gold. In other words, it's the substitution trade. You swap the one for the other. You get out of the debt, you take the gold. That is the key point. That's what's going on. And cross-comparing currencies that all have the same ailment is only going to really be useful if you're having the US that is really falling and say China's debt which isn't, because it's a producer nation, even though it has debt. And just for some people to understand that statement as well, because there's so much Pax Americana. We've got to watch out for everybody. We love the Americans, but you want to hang on. You want to believe that you're better. You want to believe you're in a better space. You'll latch on to any influencer that is an American maximalist. And I just want to show you a couple of charts that you need to understand. So there's the ECB. Let's leave our outlier, the Bank of Japan. What are we looking at actually? Percentage of GDP, central bank balance sheets. The balance sheet of Japan is right up at over 120% of its GDP. The ECB is the next worst, and it's around 40%. The BOE, Britain, is marginally better than the ECB. I don't see that staying that way for too long. The Fed is pretty much the same. The Bank of China, in terms of its GDP and what it produces, is actually one of the lowest. Yes, they have a lot of debt. Yes, they've got phony. Many people say they lie in the numbers. The communists lie. We lie. The Fed lies. Non-farm payrolls a lie. Every NFP we read out. There's 400,000 jobs that the birth-death model put in again that nobody does. How many times do people fall for this? I mean, we hold our live trading day on NFP, by the way, just because there's a key data point that's coming out. In terms of faith in the numbers, why do you have more faith? Why do you think that your peeps won't lie just as much as others, especially when their backside's against the wall? They absolutely are lying. A control or command economy can actually keep backing an industry and get it through the scale points, even while running losses for a lot longer, and then turn them profitable and then be dominant players for decades, where they get that rollback coming their way. A capitalist economy finds it difficult to scale, unless, of course, you're Amazon or Elon and you happen to be part of the insider cartel, for which there is actually a corporate fascism, and you are backed by the Rockefeller money to develop status things that persecute the citizens, and are part of the surveillance finance net. So then you will find a bottomless overdraft until you have the dominant position in an industry that actually you can't help but making money later as you sell out all the data and everything else you collect.
While demand for silver is expected to remain strong, a weaker economic outlook could alter the outlook for the precious metal. As the global markets brace for volatility, will you position with gold's stability or bet on silver's explosive upside? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.